63% of major global banks are still manually processing loan applications that take 40 days to close. Meanwhile, JP Morgan's Coin platform handles in seconds what used to take 360,000 hours of work annually. The gap between leaders and everyone else in banking isn't technology anymore. It's whether you've learned to let AI operate autonomously on your behalf. Think about what's happening right now in your operations. Your compliance team is drowning in regulatory filings. Your credit officers are buried in spreadsheets. Your fraud detection team is chasing patterns that a machine learned 3 months ago. And somewhere across your organization, talented people are doing work that has nothing to do with judgment, strategy, or human insight. The pressure isn't coming from regulators or shareholders alone. It's coming from customers who expect same-day approvals. It's coming from fintechs and neobanks who've already automated their way to profitability. It's coming from your own board asking why your operational costs haven't dropped while your competitors are running leaner. The traditional approach, using AI to augment what humans do, isn't enough anymore. You're still bottlenecked by human decision cycles, human availability, and human error rates. In the next 9 minutes, we're going to show you exactly how Agentic AI is fundamentally rewriting banking operations. Not as a future state. This is happening now. We'll break down 3 specific domains where autonomous agents are creating measurable competitive advantage: transaction processing, regulatory compliance, and customer intelligence. More importantly, you'll understand why the banks implementing this right now are pulling away from the field, and what your organization needs to do to avoid becoming the laggard that fintechs eventually absorb. The first domain is autonomous transaction processing. Here's what this actually means. An agentic system receives a loan application, collects all required documentation, validates against regulatory thresholds, runs credit scoring, cross-references fraud signals, evaluates collateral, and makes or escalates the decision, all without human intervention until a predetermined threshold is crossed. Evidence: Goldman Sachs reported a 80% reduction in processing time for back-office settlements after deploying autonomous agents. Deutsche Bank's recent implementation of autonomous transaction agents reduced settlement failures from 2.1% to 0.3%. That's not incremental improvement. That's structural change. Here's the real-world application. A mid-sized commercial bank implemented an agentic system for small business lending. Applications under $50,000 with strong credit profiles now receive funding within 4 hours. The system autonomously validates tax returns, bank statements, business registration, and credit history. It flags edge cases for human review but handles 71% of applications completely independently. The result was twofold. Approval times dropped from 8 business days to 4 hours. And the bank could redeploy its loan officers from processing to relationship management and deal structuring. What you need to do starting today: audit your transaction workflows. Map every decision point and identify which ones have clear rules, measurable thresholds, and auditable logic. Those are your agentic candidates. Start with the highest volume, lowest complexity processes. Don't try to automate your most nuanced underwriting decisions. First, build the platform with smaller wins. Then scale to more sophisticated domains. The second critical domain is regulatory compliance and reporting. This is where Agentic AI creates extraordinary leverage because compliance is rules-based, changes frequently, and consumes enormous human attention. Let's establish the evidence. According to a 2024 McKinsey study, banks spend an average of 2.1 million hours annually on regulatory reporting across a mid-sized organization. 68% of that work involves data extraction, standardization, and validation. Tasks perfectly suited for autonomous agents. Bank of America's implementation of autonomous compliance agents reduced regulatory filing errors by 91% while cutting reporting cycle time by 35%. Consider a concrete example. A regional bank with international operations faced a significant compliance challenge. They had multiple systems feeding data into regulatory reports. Loan systems, trading platforms, customer onboarding tools. Each report required manual reconciliation across these systems. An agentic compliance system now continuously monitors all data sources, flags discrepancies in real time, standardizes reporting formats, and pre-validates submissions against regulatory requirements. The bank's compliance team went from spending 60% of their time on data validation to 0%. They now spend that time on strategic risk analysis and regulatory strategy. Here's how to implement this in your environment. Start with your most burdensome regulatory reports. Document the current manual process in granular detail. Identify where human judgment is actually required versus where humans are simply executing rules. Build your initial agent to handle rule-based components while humans focus on interpretation and judgment. Most importantly, implement real-time exception handling. Your agents should be continuously monitoring, not just running batch processes monthly. The third transformation is customer intelligence and personalized service delivery. This is where Agentic AI moves from operational efficiency to competitive differentiation. Here's the landscape. 42% of high net worth clients leave their banks annually due to inadequate personalization, according to Accenture's 2023 Wealth Management Survey. Meanwhile, customers expect their bank to anticipate needs before they articulate them. Traditional AI has been useful here. Recommendation engines, predictive analytics. Agentic AI is different because it takes autonomous action based on that intelligence. A global investment bank implemented an agentic wealth management system that operates 24/7 on behalf of client portfolios. The system monitors market conditions, regulatory changes, tax events, and client-specific objectives. When it detects an opportunity or risk that aligns with a client's strategy, it prepares a detailed brief, not a notification, and escalates to the appropriate relationship manager. More sophisticated, it handles routine rebalancing tasks autonomously for clients who've granted standing instructions. The result was measurable. Clients in the Autonomous Intelligence Program saw average portfolio outperformance of 1.3% annually compared to the control group, and satisfaction scores increased 31%. The actionable takeaway? Build customer intelligence systems that move beyond prediction to recommendation and eventually to autonomous action. Start by identifying use cases where you already have explicit client permission and clear decision rules. Implement transparent systems where clients understand what actions the agent can and cannot take. This builds trust rather than creating the Frankenstein scenario where autonomous systems make decisions clients experience as black boxes. Now imagine your organization in 18 months after implementing this intentionally. Your loan officers are spending time building client relationships and structuring complex deals, not processing applications. Your compliance team is focused on regulatory strategy, not data entry. Your relationship managers have AI-driven insights that arrive before they have their morning coffee. Your customers experience a bank that moves at the speed of their lives, not the speed of your organizational processes. More fundamentally, your cost structure has fundamentally shifted. Your competitor is still hiring more processors because their volume grew. You've automated your way to serving 40% more customers with the same headcount. That's not just margin improvement. That's competitive moat creation. When you can serve customers faster, cheaper, and more intelligently than anyone else in your market, the conversation stops being about technology differentiation. It becomes about market domination. The banks that move on this now will own their markets by 2026. The banks that wait and treat this as a future initiative will be acquired or marginalized by them. The insight here is clear. Agentic AI in banking isn't about having the smartest system. It's about having the most autonomous system. It's about building operational velocity that humans simply cannot match. If your organization is still thinking about AI as a tool that amplifies human work, you're already behind. Subscribe to Apex Minds to get weekly insights on enterprise AI, organizational transformation, and the future of leadership in an autonomous world. Hit the notification bell so you don't miss our deep dives into how leading organizations are actually implementing this technology, not just talking about it. In our next video, we're breaking down the 3 critical infrastructure decisions that determine whether your agentic AI initiative succeeds or becomes a $70 million sunk cost. That's the difference between leaders and laggards. We'll see you there. Thank you so much for watching this video. If these insights resonated with you, please subscribe to Apex Minds D4J and hit the notification bell so you never miss our weekly content. Share this video with a colleague who needs to hear it. We will see you in the next one. Keep pushing forward. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.